If you can maximize your Social Security benefit, you're going to have a much more comfortable retirement. So in today's video, I'm going to share with you 4 simple things you can do to maximize your Social Security benefit. Let's jump right in, because the first thing that you need to do to maximize your benefit is really understand how benefits are calculated. When you understand what happens on the back end, you know what to do to get more out of your Social Security benefit. The first thing to know about Social Security is the way it's funded isn't through normal taxes. You have federal income taxes, you maybe have state income taxes based upon the state you lived in, then you also have payroll taxes. Now, payroll taxes are a combination of Social Security and Medicare taxes. So every dollar that you earn, up to $168,600 for 2024, 6.2% of those dollars is taxed, and that goes into the Social Security system. Now, another 6.2% is also paid on that wage base by your employer. So a total of 12.4% of the first $168,600 that you earn for 2024 is taxed and goes in to fund Social Security. Now, there's an additional 1.4% that you pay for Medicare and 1.4% that your employer pays for Medicare. And combined, those Medicare and Social Security amounts are what we call payroll taxes or FICA taxes. But when it comes to calculating Social Security, that 6.2% on the wage base of $168,600, that's what your Social Security benefit is based on. Here's the second thing to note, is your Social Security benefit that you see. So if you go to ssa.gov and get your Social Security statement, they will tell you how much you're eligible for at age 62, at your full retirement age, and at age 70. They are basing those benefits on your highest 35 years of earnings. So it doesn't matter if you earned, say, $1 million a year for 20 years. That high income isn't going to give you a full Social Security benefit because Social Security is looking at your highest 35 years. Any years that you don't have earnings, Social Security simply uses a 0. So when you're seeing or trying to figure out how much am I going to get from Social Security, they're going to look at every one of your highest 35 years. They're then going to adjust it for inflation, and your benefit is going to be calculated based upon that. So that inflation adjustment or index adjustment looks like this in practice. For 2024, I mentioned that your Social Security wage base is $168,600. If we were to go back 30 years to 1994, that same Social Security wage base was $60,600. So in other words, in 1994, if you earned $60,600, you got as much credit towards your Social Security benefit that year as you would in this year, 2024, for earning $168,600. So every year that wage base goes up and your earnings are indexed for inflation to ensure that that normalizes what your earnings are over the course of your career, of course, accounting for inflation. The next thing that you need to know that most people actually are fully unaware of is that your Social Security benefit is means tested based upon something called bend points. What does that mean? Well, let's assume you've earned the $168,800. You have fully maxed out what your Social Security benefit can be for the year. Now, let's say you've earned exactly half of that, so $84,300. Does that mean you would get exactly half of the Social Security benefit you would have received by doubling that and fully paying into Social Security? The answer is no, and it's because of those bend points. What bend points essentially mean is that the first dollars that you earn are weighted more heavily in terms of how Social Security calculates what your ultimate benefit will be. So for example, the first $1,174 that you earn, 90% of that goes into calculating how much your Social Security benefit will be. Doesn't mean 90% is tax, it just means those first dollars are more heavily weighted in terms of determining what you're gonna get from Social Security. The next amounts, from $1,174 up to $7,078, 32% of that goes into determining how much you're actually going to get that year based upon your Social Security earnings. And then above that, anything above that amount, only 15% of that goes into determining what your Social Security benefit will ultimately be. What's the bottom line from all this? It means that if you have a lower income, say your income was never above $40,000, $50,000 per year, even indexed for inflation, as compared to someone whose income was at the 160 to 170 range per year, your benefits aren't going to be proportional. The lower your income, the more you're still going to get from Social Security because those first dollars that you earned were more heavily weighted in terms of the calculation. Those are Social Security bend points. The next thing that you need to know when it comes to understanding your Social Security benefit is what's called your primary insurance amount, your PIA. Your primary insurance amount is the benefit that you are eligible for at your full retirement age. Now, based upon your date of birth and the year in which you were born, your full retirement age is going to be somewhere between 66 and 67 years old. It goes 66 years old to 66 years old in 2 months, 66 in 4 months, 66 in 6 months, based upon your age, and 67 is the oldest full retirement age you currently have. Previously, this used to be 65, but if you're watching this video and not already collecting Social Security, it means you're younger than the age you would have needed to have been to collect Social Security at 65 as your full retirement age. But keep in mind, that's called your primary insurance amount at your full retirement age. Then the last thing that you need to know, and then we're gonna go into how do you actually maximize your benefits, is you can collect your benefit as soon as age 62 at the earliest for your own retirement benefit, or as late as age 70. You don't have to collect at age 70, but your benefit's not gonna grow anymore if you don't. So 62 to 70 is the age that you need to collect. By the way, if you're enjoying this video and you feel like you're learning something new, make sure you subscribe, clicking the subscribe button below. Every single week, I'm gonna put out a video with the goal of helping you to understand more about retirement, understand things you can do to maximize your retirement. So make sure you like this video, make sure you subscribe, because every week we have a new one. So let's jump into the actual things you can do. Now that we have an understanding of the landscape of Social Security, of how is your benefit even calculated, now there's 4 simple things you can do to actually increase your retirement benefit. Number 1 is work a full 35 years. As we mentioned, Social Security, when they're calculating your benefit, they don't care how much you earned in any 1 year. 1 year of huge earnings can't offset other years where you earned nothing. So work 35 full years, but also keep in mind that you don't have to work full time for 35 years. If you remember from the bend point discussion, the first $7,078 that you earn, that's for 2024, that number's indexed for inflation each year, the first $7,078 that you earn is weighted most heavily in the calculation of your Social Security benefit. So maybe you've worked 30 years and you're thinking about retiring or collecting your benefit. Well, the final 5 years that you have, if there's no income, Social Security is going to treat that as a 0, and your benefit's going to be adjusted down. Don't think about, oh, I have to go out and earn a whole bunch of money for those 5 years, but what if you just earned $7,000, $8,000? What that's gonna do is those dollars are weighted most significantly in the calculation of your benefit. That could play a major role in helping you to increase your benefit and get rid of the zeros that Social Security would otherwise use in calculating your retirement benefit. Number 2, the second thing you can do to increase your Social Security benefit is wait to collect, if possible. Before your full retirement age, which again is between 66 and 67 for those of you watching, your benefit will increase by either 5% per year or 6.67% per year, depending on your age and how far out you are from full retirement age. So every year you wait, your benefit is increasing. Also, you don't have to wait a full year for your benefit to increase. It's increasing on a monthly basis. So it's not as if you have to wait from 62 to 63 to get credit for a higher benefit, or 66 to 67 to get credit for a higher benefit. Every month that you wait, a prorated amount is being added to your benefit, and the longer that you wait, the more your benefit is going up. If you wait to collect Social Security after your full retirement age, so if you've already reached your full retirement age, then every year after that, up until age 70, you get what are called delayed retirement credits. Delayed retirement credits means your benefit increases by 8% per year, again done on a monthly basis, every year between your full retirement age and age 70. So if your full retirement age is 67 and you don't collect Social Security until age 70, even if you don't have any income, even if you're not still working between 67 and age 70, your benefit is going to be 24% higher at age 70 than it would have been at age 67 because of those delayed retirement credits. The third thing that you can do to increase your Social Security benefit is consider spousal benefits. So when you go to collect Social Security, you are eligible for either 100% of your retirement benefit or 50% of your spouse's retirement benefit at their full retirement age. This is a spousal benefit. So maybe you stayed at home and you raised a family, or maybe you worked but you weren't earning that much. And if you look at your spouse's earnings record, they have quite a high benefit, but yours is quite low. Well, don't be discouraged. Just because yours is low doesn't mean you actually have to collect your benefit. You are eligible to up to 50% of their benefit if you wait until your full retirement age to collect. Now, your spouse has to be collecting their own benefit in order for you to collect a spousal benefit based upon their earnings record. But this is really important to know in terms of Social Security strategy, that you can potentially dramatically increase your benefit, not because you have to go work a whole bunch of years if you don't have a strong earnings record in the past, but just by collecting a spousal benefit. One important thing to note is spousal benefits apply even if you are now divorced. If prior to being divorced you were married for at least 10 plus years to your previous spouse, you are still eligible for a spousal benefit on their earnings record. That could potentially change if you've been remarried after certain ages, but if you are divorced and you have a spouse that you're married to for 10 plus years, you're still eligible for a spousal benefit based upon their earnings record. And then the fourth thing that you can do, and this is really a crucial thing that everyone who is married should be thinking about when it comes to Social Security strategy, is what's called a survivor benefit. If you have a spouse that passes away, you are eligible for 100% of the benefit they are eligible for that they are already collecting, and you can then collect that survivor benefit. On top of that, for a survivor benefit, you only have to wait until age 60 to collect it, as opposed to age 62. Now, you're taking a reduction for doing so, but with a survivor benefit, you can potentially collect a whole lot sooner than you otherwise would have with your own retirement benefit. But where spousal benefits get really interesting is when you're planning a Social Security strategy. Let's assume your spouse passed away and you collect a spousal benefit as soon as age 60, but you also had a strong earnings record. What you can do is you can collect that spousal benefit from, say, age 60 to age 70, and then switch to your own benefit at age 70. I've done this with a number of clients where their spouse passed away, and what we did was we said, let's take your benefit, the surviving spouse. It's a strong benefit, but we want that to grow as much as possible all the way until age 70. So instead, let's collect your survivor's benefit today, which provides you immediate income, and then we're going to take a huge step up in income when you turn 70 and get a jump to what your own benefit would be. Now, in many cases, it's actually the opposite. Maybe someone collects their own earnings record today or their own retirement benefit today based upon their earnings record, and they defer their survivor benefit until a later age. So whatever the strategy might be, just understand that survivor benefits are really powerful planning tools, especially when you're going into retirement married or already widowed, but just understanding how do you either use a survivor benefit today or plan on future implications of one spouse predeceasing the other, and how does a survivor benefit help you to maximize your total retirement income as well as protection for their surviving spouse. So I hope that's helpful to understand both how Social Security is calculated as well as the 4 things that you can do to increase your Social Security benefit. Now right here, I'm posting a link to another video where, as much as it seems like you should make the Social Security decision in a vacuum, just with regards to Social Security, you also need to take into account how this impacts your investments, how this impacts your tax strategy, how this impacts every other component of your financial plan. So in this video here, I'm including a case study that shows you how does this decision with Social Security actually impact everything else, so you can make the decision that's best for you. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.